It's a common misconception that carbon credits and carbon allowances are the same thing. In this video, we'll review the differences between these assets and how we as retail investors can gain exposure to this emerging asset class. So what is a carbon allowance? A carbon allowance is a permit to emit 1 ton of carbon dioxide into the atmosphere. Carbon allowances are created by a government or standards body who put a cap on the level of acceptable emissions in a particular region, with that cap decreasing every year. Based on that cap, every company involved in the compliance carbon markets receive a certain number of allowances, which are tradable between market participants, which tend to be heavy emitting industry like power plants, industrial manufacturers, or other carbon-intensive production facilities. So the establishment of these markets create a financial incentive for companies to reduce their own emissions. If they do, then they can take the extra allowances given them and sell those allowances into the market to other companies that need to offset their own carbon footprint. By contrast, carbon offsets, also known as carbon credits, are used in the voluntary carbon markets, VCMs for short. Carbon offsets are created by carbon reduction projects registered with independent carbon registries like Verra or Gold Standard. Some examples of these types of projects would be carbon capture and storage facilities, or projects protecting forests to avoid the threat of deforestation. It's typically fine to use the term carbon offsets and carbon credits interchangeably, but it can become an issue when dealing with hybrid carbon markets like the one in Australia. Those markets combine certain aspects of both the voluntary and compliance markets together. So carbon reduction projects that would typically operate in the voluntary carbon markets are now under the authority of the Australian government. And the Australian government controls the issuance of Australian Carbon Credit Units, or ACCUs, which are given to these projects when they reduce or remove carbon emissions. So in Australian markets, there is no such thing as carbon allowances. Now the government-affiliated carbon units are being called carbon credits. So to sum up what we've gone over so far, a carbon allowance is a permit to emit 1 ton of CO2 under a compliance carbon market run by a government or standards body. Carbon offsets represent 1 ton of CO2 emissions that were avoided or removed from the atmosphere by a carbon project in the voluntary carbon markets. And carbon credits are essentially like carbon offsets, but issued by the government instead of an independent registry. Although many people will end up using the terms offsets and credits interchangeably. Moving on, we've seen a variety of compliance carbon markets open up across the globe. Some of the most popular being in the European Union, the Western Climate Initiative, which includes California, Washington, Quebec, and Nova Scotia. And there's also the RGGI, which is in the northeastern region of the US. So there's just a few examples there. With that said, how do we invest in the carbon allowances these markets utilize? I'll link to another video explaining carbon offsets more in depth, but for now we're going to focus on carbon allowances. So the easiest way for retail investors to buy exposure to carbon allowances is through publicly traded ETFs. The most popular one being the Crane Shares Global Carbon ETF, ticker KRBN, which offers exposure to the EU, the California carbon markets, RGGI, and the UK markets through carbon allowance futures contracts. And if you have access to buying futures contracts, you could theoretically buy them yourself, or the last option is through cryptocurrency. One example being Kakubi, which is a crypto token where for each individual token you buy, it's individually backed by a carbon allowance from the European Union's emissions trading system, which is different from the ETF options because this is the equivalent to buying an actual EU carbon allowance, whereas the ETFs are buying underlying futures contracts, not the commodity itself. So that's the difference there to keep in mind. But yeah, if you'd like to learn more about a variety of possible investment options, the individual stocks, and how compliance markets work, I'll link to those previous videos I've made on those topics in the description below. And thanks for watching.